Look, you had a brief relief rally yesterday, but it was based on what was a desperation move in the UK to forestall really a cataclysmic event, which is a major unwind of the financial system there. So big cap tech, if you're taking a look, let's put Apple aside now because I know we'll talk about it later. But you've got these companies for the first time. These are major growth companies making major moves in layoffs, cutting back projects. We saw that Google shut down Kitty Hawk last week. That was kind of surprising because that's what they do. They look to the future, they invest. So while they're cutting heads and while they're looking at slowing growth rates, and this has nothing to do with regulation, that comes on and gets even worse, these stocks are no longer cheap. So like every other one, you're going to see.
Cheaper. They're getting cheaper because Alphabet, Microsoft, NVIDIA, new 52-week lows today. The XLK Semis, new 52-week low today. These stocks in 1 month, Apple down 11%, Amazon down 12%, Alphabet 11.5%, Microsoft down 11%, Meta 14%, NVIDIA 23%.
But here's why none of them are getting cheaper, because we haven't seen the reset in earnings. And I'm still looking at a target of $200 in S&P earnings, and you're not going to get to $200 without having these big cap tech stocks come down as well. So until the market comes to grips with that, I question as to whether these stocks are cheap enough.
Okay, so let's leave it there. Kerry, to that point, right, do these stocks have much further to go? They're the most important if you look at the weighting of the market. They matter more than almost anything else for obvious reasons.
Well, they still have large market caps. And to the extent that Steve is worried about earnings are coming across the board down. We know that's going to happen. But even with lower earnings, if you look at what's happened with a stock like Meta, which is down 65+% over the last 12 months, those lowered numbers are certainly at the point where the stock is trading at either 12.5 times next year's earnings or 15.5 or 16 times. So even with much lower numbers, you've got a multiple that is 30% below what most consumer staples are selling at. And I'm not suggesting that Meta doesn't have any problems or that the advertising market that Meta and Google are a large part of isn't problematic, but Google sells for 16 times earnings. Maybe it's 18 times earnings, but that is so much lower than where it was. And these companies are still growing faster than the economy, growing faster than almost all the consumer stocks out there and most industrials. And so you look for bargains where you can find them. And these stocks have to be attractive to some value buyers. And the growth of people who don't own them should be buying them now because their growth rates, while down over the next year, are still going to be faster than the GDP and the S&P is going to grow.
You look at the forward PE of Apple, Josh, you made the point yesterday in overtime, even as a shareholder who loves this company, that you can make the argument that Apple is too expensive here.
Yeah.
Well, you cannot make the argument that Apple is cheap. So as I discussed yesterday, on any metric, you want to look at this stock and pick the top 6 or 7 valuation metrics. It's not cheap. The bigger question is, so what is the punishment for that? Well, we see this is a stock that has outperformed the market for the last 9 months, year to date, and now it's underperforming. It's worse today than most of its brethren. And, it's just, I guess to me, it's just not that surprising that you would see a stock like this have to eventually catch down. So today you have Apple down 4%, Microsoft only down 2%, Meta only down 2%. Those stocks have already come in a lot. So it makes sense to me that now it's Apple's turn. We've seen this repeatedly, by the way, in the last, 10 years in market corrections. Apple has been very stubborn. It very rarely is at the vanguard of a move lower in the market, but eventually they get to it. So I think that's what you're seeing right now. I don't think anybody should be terribly surprised by it.
No, I mean, the downgrade today from Bank of America was the catalyst for, I think, today's move. Downgraded to neutral. That's from buy. Price target to 160 from 185. And a lot of that has to do with expected slowdown, Brenda, in consumer spending. And that Apple's going to take a hit as a result of that. You already had the report yesterday questioning whether, they were going to increase production of the new iPhone, suggesting they were not. So now you've got 2 days in a row of negative reports coming out about Apple.
Right. And I think, at the end of the day, Apple's a consumer products company, but it's also a global consumer products company. So that, when you think about where does their revenue come from? Well, about 60% comes from overseas. So even if we can all get comfortable with the U.S. consumer, given the strong job market, savings, et cetera, I think we have to look to what might